Okay, guys, we'll get started here. So these are what we call episodic pivots. This is on QCOM, and uh, the trade took place on November 4th, but I just closed it out today. So, or yesterday, my fault, or Friday. So essentially, what the trade strategy is we find a stock with significant earnings report, ideally beats big on EPS revenue, raises guidance for the next quarter or year. We want to see a lot of analyst upgrades with out of the money upgrades. Yeah. Stock trades in a range for 3 to 6 months prior to breaking out. The longer the consolidation, the better the breakout's going to be. And off this episodic pivot, we want to see at least a 10% gap. Now, this gap could be a little bit subjective. Sometimes I've traded it 7%, 8%. But the closer it is to 10%, I find that these setups work well, right, for multi-day swings. We want to be in a hot sector. We want the overall market to support our direction. We want to see option flow with out-of-the-money strikes. For our initial entry, we're going to be risking the opening range low for our swing. We want a high short float over 5%, but under 20%. If the short float's too high, it's kind of hard to trade. So that 5 to 20% is ideally that sweet spot. Low institutional ownership under 80%, ideally as low as possible, right? That way, if it's lower, the analyst upgrades could have certain institutions buy up the stock if the institutional ownership is lower. We want a lower float under 800,000, or I'm sorry, that's supposed to be 800 million, not 800,000. Stock could trend for a few months. We look for multiple ways to get involved if this trade is working. So that means second day plays, scalps, bounce trades. The quote that I have on the bottom here is when the cruise ship gets going, it's really hard to pull around. And that's exactly what we're trying to find with these stocks. That this is a big catalyst and it's going to make this stock trend for multi-weeks or a few months even. So here are the potential reasons to sell in my favor if price target is reached. If it trades over 1 ATR off the open very aggressively, you scale out some. Hits a standard pivot point and rejects that price, you would scale out some, or rejects the hourly Bollinger Band or daily Bollinger Band as well. Against me, if it breaks low of the day, trades under the 5 and 10-day simple moving averages on the daily. If there's a seller into a key level on the tape, does not hold the 10-day on day 1 or the 20-day on the hourly on day 2, or if our just daily uptrend gets broken. Now, before I continue, do you guys have any questions or can I move on? Well, we'll see the executions in a second. You have to treat them as different trades. I'll get to what I mean. Institutional ownership is the amount of institutions that own the stock in comparison to the float. So our initial trading plan is to find areas to get long via a bounce, a breakout with a solid risk to reward ratio where you know you're wrong, right? Buy as close as to the 10% gap as possible. Save risk for additions, right, to the position. Use other aspects of my playbook to add cash flow to this trade. That can mean second day plays, opening drive plays, bounce trades, whatever. The initial entry I took was off the VWAP pre-market when it spiked down. It just it was up like 13, 14% pre-market. Spiked that down to 10% again near VWAP, and I got in just risking $2, right? Here is the backtest for QCOM. Nothing super significant. We don't really have too much continuation after earnings. nor we have a drift higher open to close. So what this backtest is telling me is that there hasn't been a pattern of an episodic pivot in the past. So we might have to be a little bit patient with our entries. We have to save risk if this trade is going to work. But at the same time, we have to be open-minded because we don't have this specific variable in our trade. Here is the bigger picture. So SPY and QQQ are very bullish and strong uptrends. At this time, IWM was starting to break out of a long-term base. SMH, which tracks the semiconductors, are red hot, right? As you can see right here, this is the 1 month return of the semiconductors. The semis have been carrying the market when it comes to SPY and QQQ, I believe. The supply side shortage with high demand forces prices for semis to go up. So NVIDIA, AMD, AVGO have been super hot recently. This is about the same time where we get introduced to the metaverse, and the metaverse could only work with semiconductors. So it was only natural that these are major catalysts for a lot of our popular semiconductors like NVIDIA, Qualcomm, AMD, MU. This day, Powell had very important news. He said that we could be patient on interest rates. Our baseline expectations is supply chain issues will persist until next year, which is bullish for semiconductors. Supply and demand imbalances have contributed to a sizable price increase. Again, that is why they think inflation is higher, but that drives up prices and earnings for companies like this. Taper will most likely conclude middle of next year. So that's what Powell guided for this FOMC meeting. And you could see November 4th, we were in the middle of this really strong uptrend. So very bullish for any swing trades. Here's our semiconductors, very strong, broke over that 276 resistance. And the day that Qualcomm was running, it carried the semiconductors up this candle, and we just had a very bullish run up since, following the 5 and 10 and 20-day moving averages. And now we reclaim the 5-day today. So very strong semiconductor market. Here's our technical analysis on Qualcomm. This is exactly what we want to see for an episodic pivot, where we have a very long consolidation from their earnings in February. That's 1 quarter, 2 quarters. Now the third quarter of consolidation, we're finally gapping up above this range. And we gap up above this range, we set up for an all-time high break, and also just, I'm not sure if it's 52-week highs, but we're setting up to test higher prices, which is bullish. If this gap holds, then we could expect this to be a strong stock in the next coming months. And you could just see the volume here that is supporting this move and the support of the 5 and 10-day moving averages here. Even on Friday, when we got that sell-off, we held up very nicely and reclaimed that 5 and 10-day moving average today. Here's our hourly charts. Our earnings breakout follow this trend line. We had an overall market sell-off this day, but we ended up reclaiming all these moving averages on the hourly, and we started to base. We started to test this resistance point, and then the next day, another breakout. And now we've been just consolidating for a few weeks. I would expect that Qualcomm should move higher in the coming days as well from the other screenshot. But overall, this is a very strong stock. And here's our 5-minute chart. Here's our gap up. My entry was a little into here, this VWAP right here. So, and I was risking just $2 under that for the initial swing. But usually for our day one moves, since it's a high gap up, what I've noticed is that day one is filled with consolidation. So you have to be patient with how it plays out, right? You want to be buying the bottom of this range rather than buying the breakout above it. It's our day two plays where we get the breakout with elevated volume. So here are intraday fundamentals. Qualcomm earnings and revenue beat Wall Street expectations. Its chip sales for smartphones were up 56 year over year. 56%. Offered strong guidance for the quarter. This suggests that Qualcomm is weathering the global chip shortage that has affected other chip makers and customers. We had a 13% EPS beat, guided revenue for 7% higher, which is pretty good for a blue chip like this. Big players in providing infrastructure for the metaverse with the semiconductor tech that they offer. And here are our statistics. So our average daily volume is 6 million shares per day. The RVOL was almost 6.8, so it did almost 7 times this amount of average daily volume, which is extremely high, even for an earnings report. Usually you see like 3 to 4. This was almost 7x. The short float is 1.3%, which is not at our 5% range, but it is considerable for a short squeeze, considering the shares float is 1.2 billion. So that's another thing. This is like a stock that is a little bit liquid, but not entirely liquid. Something like Bank of America, Ford, Apple, which I don't really like to trade. This is something that I could manage, but you have to be patient for this stock, right? Big moves are going to be supported with big volume, and if it doesn't get that volume, then it usually trends higher slowly. Same thing with the institutional ownership. It's near that 80% mark, but we had so many upgrades off its earnings with out of the money price targets with big banks, right? We have Morgan Stanley, Wells Fargo, Goldman here. These are really big upgrades that we have here. So here's our variable checklist. Pretty much all our checked. There's a lot of checks in our favor. The only thing that really doesn't check out is the short float institutional ownership and the lower float under that's supposed to say 800 million. It's in the billions, but that is perfectly fine. We still have a great setup on our hands that is deserving of a lot of risk because these are pretty much the main aspects of the trade. So here is my first entry. I bought pre-market at 153.90 when there was a spike down into VWAP, just risking that 152 mark. I sold 1/3 of my swing trade into one ATR, and then I ended up getting stopped out when it broke low today in anticipation that it will gap fill, right? Now notice how I treat these as different trades, right? I still made about like, I don't know, 2R on this trade. I still got in at 54, sold some at 159-ish, right? And then I ended up getting stopped out above my entry, right? So in nature, this is already a winning trade, but I could readjust my risk based on how it's trading, right? If it was strong and continued, then that's fine for the swing. But we want to manage our core a little bit differently, right? So for our second entry, now this is a 15-minute chart. I bought some when it reclaims that new low of the day, and I bought some more when it came back into that 154 support. Still risking 152. And this also lined up with a few moving averages as well, right? So basically, I want to get as close as possible to that 10% gap. So I realized that, you know what, maybe risking low of the day may have been too tight of a stop. So I re-entered with small size here with the intention of averaging down if it reached that price, right? I could have played the second day play and take this breakout, but I guess I wasn't watching it at the time. That could have been another execution. But I sold another fourth into the 167 level as a rejected. And then I ended up getting stopped out on this this day when the market just randomly fell. No news, no nothing. It was just super low volume sell order here. In hindsight, this could have been an area for me to add. But since this was like a new setup that I was kind of like experimenting with, I didn't really want to give out too much profits. I would say, you know what, if this is still strong, I could always re-enter. I don't want to be chopped up in some random ass selling from the overall market, right? So I made the mistake of stopping out here. Maybe I could have stopped out even a little earlier. But again, this is a monster stock. It's okay if we get stopped out lower. We could always re-enter when it's proving itself again. So here's our third entry. We had that selling, and now we reclaim that area and started to base above it, right? So if I buy into here again, I could risk this new low as my stop loss. That would actually be confirmation that the trade is not working. We move higher, sell off, boom. If we reject into here and make a new low, that means the trade is over and it's going to start gap filling to the downside. But if we hold this area, right, this 165 to 160 range, and we start basing above that support, then it sets up for this curl, right? And then we just took profit into resistance points, some into 180, some into 190, and then I got full out into 185 here as it rejected for the second time this resistance. My intention was if it rejects this price, it has significant downside, right? This stock is already up like 40% in 2 weeks, right? The next play would be if I bought above this 190, right? If you buy above this 190, it has a spike into 200, 210, right? I'll take a breakout trade instead of me anticipating it, and we end up double topping here on the daily and then rolling over. And then for the fourth entry, this was a really stupid execution, to be honest. I bought this the Wednesday before Thanksgiving, after hours, because it sold off like I anticipated, right? It rejected that 188 area, sold off, found some support into the 180s, 175, started to base. And then after hours, it just gapped up with like very little volume, right? I think it was just like an overall market gap. And I said, you know what? I'll just buy again, risking this low. And then I ended up just getting stopped out on the open, right? Which was stupid because off the open, it just literally ripped right back into this consolidation, right? So this was kind of a bad stop out and too much size, in my opinion. I did make a significant amount, but like this fourth entry is a little bit extra. The next entry could be something like today where it reclaimed the 5 and 10-day moving average on strength, and now we could watch it for a day 2 play. Or we could be patient and watch for this 189 breakout. But this kind of execution is not really my style. So I just have to be mindful of that, I guess. Trade review. So we were experimenting with this new setup. Since there were so many variables in my favor with a massive beat off earnings, breaking 52-week highs. I'm not sure about the 52-week highs. I think it was just all-time highs. Or near all-time highs, and then it broke out. But anyways, hot sector with a strong chart. I added size, and I was very open-minded about re-adding into the position after getting stopped out. The consequences were that this is almost a 20-hour win. My risk was very tight, and I was able to put on size for every single one of my trades, right? This was the largest win so far in my system, so far, because I'm going to have better trades than this. Probably, but this is a trade that you could make your career out of. I think the variables for it are very specific. I did a pretty good job finding a stock like this and being open-minded. I could try to get a little bit more specific with my trade plan and my reasons to sell. Usually for my second day plays and scalp trades, they're like, okay, here are my defined levels. Here is where I know I'm wrong. This one was a little bit intuitive. And when I start to get more trades in like this and have more data, I could try to find a better system to trade this. But overall, for just like an intuitive sense, that's fine. Like for example, like just these entries and exits, if I just held the all the way through, then it would have just been better than me trying to be a little bit nimble, right? I mean, there are areas to re-add, right? Or day trade it, like for example, this 170 break or this day 2 play, right? So you could add cash flow in that sense, but maybe I got to zoom out and see the bigger picture. Okay, is it holding a 5 and 10-day moving average? Does it really matter that an hourly moving average crossed over? I'm gonna like look more deeply on how I could refine my reasons to sell for this trade, so I could trade it a little bit better next time around. But that's all for the trade review. This is a classic example of what a playbook looks like. If you guys want to learn more about this, I have some other YouTube videos I could share with you guys. But essentially, this is the template that I use to kind of review my trades and build my system out of. So let me know if you guys have questions in the chat. How do you find the criteria for this trade with Finviz? So, I mean, SMB Capital has like a little screener that we could use. I filtered it through there. But on Finviz, like you could literally just filter the criteria that I had before. What was it? 10% gap up off earnings. Another thing that I should have mentioned here, actually, I'll add this after the slide, but I wanted to do one average daily volume within the first 20 to 30 minutes. But this is the trade strategy. You could build out a Finviz scanner based on this. You could be a little bit lenient with the short float and other stuff, right? But literally just scan for 10% gaps. And if you notice they report earnings or anything, then that could be an episodic pivot. For example, the LI that we looked at today, that could have been an example of an episodic pivot. It fits this criteria pretty well. Yeah, I mean, the pattern is pretty similar. We go to the charts. This is QCOM's chart. Let's do LI really quick. Yeah, not like not the best looking chart, but pretty damn similar, right? Where we had shitty earnings all their quarters, and finally they posted a good profit. Their average daily volume is pretty small, and it did almost 26.4 million shares. Let's see what it did on Finviz. So LI. It did almost 4 RVOL right here. No price upgrades yet, but very low institutional ownership. Here's our daily chart. It gapped above this area of consolidation. Even Finviz has it. Like ideally, I would want it to see it gap up above 36, but it's okay. But it's setting up like this is a classic flag. So if we get volume on our day two, I don't see why this cannot be an episodic pivot. Right? And where would we risk? Just this low of the day right here. Under this probably this high. So I'd risk under 33.83. You traded stock. I did both. But some other examples of the episodic pivots that we walked into was Roblox. This is what Roblox looked like for its episodic pivot. TTD is another example. consolidation, gap up, swing trade for the next week or so. Um, what's another one? Would OSTK be one? No. Dollar Tree. I missed this Dollar Tree, but here is another example. Tight consolidation here. Wow, look how tight this is. We get the gap up here. Boom. Very big swing trade, reported earnings, and this is about, like, say you enter near this is almost a 20% move. I got December 17th contracts. So that is 1, 2, 3 weeks. I don't suggest 3 to 4 months. I'm a day trader. I don't want to be holding shit for that long. Like if you look at other episodic pivots in the past, like Team, like this is another episodic pivot where it gaps up 10% off a really good earnings report. You know, I was full out when this moving average crossed. I would be out. I'm saying I didn't trade this, but I would be out if this failed here. But it went another few points. I mean, do you want to stay in this for 55% or get out at like 30? Like, you're still risking very little. Like, say you enter near this area and you risk the gap, you make almost 8R for this. That's still really fucking good. And you could always re-add and manage your risk better. You don't have to hold it for 14R or 15R. We just have to have a positive expectancy. Yeah. Yeah, that would be the risk. But I have to study more of these trades for the initial reasons to sell. Maybe we can swing this into like for months on end. I have to do more research on it. Yeah, of course. This setup maybe has a 25% win rate, but the risk to reward is like 8. So, for example, Blink didn't work. I had that 10% gap up and failed. And I thought this Blink was going to be super cool too because it did consolidate for a long time, has a high short float, and the EV sector is hot. Doesn't have to work. Nothing in trading has to work. Could always trade differently. That's why we manage risks as traders. You can't have ego and be like, all right, I'm wrong here. Next trade. That's it. Some examples of what is it called? Episodic pivots to the downside would be stuff like Z. This is the reverse, where we have shitty earnings, consolidation, gap down, and then multi-week swing. Eton, same thing, gap down, multi-week swing. Twitter, holy shit, Twitter gave back that entire move. That is really unlucky. But similar pattern where we get that gap down off earnings, multi-week swing. You should go into each trade with the worst case scenario in mind. If you were to lose the money that you put in, what would it be? You can go in thinking I mean, you have to think positive. You obviously want to trade the stock, but think of it from a risk manager perspective. What is always the worst case scenario for this playing out? That's why we build out these playbooks, right? What are the specific reasons for you to trade this, right? What are my specific reasons to sell? What's my strategy to take profit? Being as specific as possible is how you build edge in markets. Not just saying, all right, this technical pattern looks cool. Fuck that. Combine multiple variables. We have earnings, we have the metaverse, we have fucking volume behind our back. These are the trades that make your month, not like these low volume like price spikes. And it's doing the work to find these trades and research them and trade them better the next time. I killed this trade, right? 20R trade. This was the best trade I've done. But does it sound like that? If I didn't tell you I made 20R, what would you think I made on it? The whole point is that you have to get better no matter what. This trade could have been improved. It could have been 30R maybe. Who knows? Like this entry right here was dog shit. So always improve. Find ways to get better. And that's what this playbook is all about, to help you build your system. All right, guys, let me know if you have questions. If not, we'll wrap up really quickly. Well, not exactly. The stop loss has to be calculated based on the chart. I'll post this to YouTube. Why not? I'm streaming it, so I'll post it. It depends, right? I think maybe like risking 5% on the trade, like say it's a 10% gap, risking 5% might be the move. Again, I have to do more research on it. For my second day plays, I always risk low of the day. So that's with this playbook, right? But I guarantee you the next time I take an episodic pivot like this, it's going to be a different reasons to sell. And I'll share that with you guys. With the whole playbook, you do this so you can internalize the trade and then improve upon it next time. We noticed together that our reasons to sell were not that ideal because we entered and exited a few times, right? So how can we clean up this trade? By getting more specific with our trade plan and getting more specific with our reasons to sell. It was kind of subjective, like, all right, it's coming into this level, let me take it off. All right, there was a low volume sell off, let me take it off. Well, maybe that's an area to add instead. Low volume selling is a gift for us. All right, cool. I think we'll wrap up now. If you guys have questions about this trade, I can send you the PowerPoint. Just ask it in one of your team channels or whatever. But thanks, guys, for tuning in.